Did you know the concept of calculating net worth goes all the way back to ancient Egypt? Scribes would meticulously document the assets and debts of pharaohs and nobles on papyrus scrolls, basically the OG balance sheets. Pretty cool that a financial practice from thousands of years ago is still so relevant today. And speaking of net worth, that's exactly where we're starting on this journey through personal finance formulas. Because understanding your net worth is step one before you can really map out a solid money plan. These formulas we're covering today won't instantly solve all your financial problems. But they will give you a much deeper understanding of your overall financial picture and how to improve it over time. So, grab your calculators and get ready. It's time to master your money and achieve financial success. This is the Finance Virtuoso channel, where we talk about all things finance. If you're new here, be sure to subscribe and hit the notification bell so you don't miss out on any future money tips and tricks. Alright, let's get into it. The first few formulas we're covering are all about giving you a clear picture of where you're at financially right now. That's step one to putting together a solid plan for the future. First up is your net worth formula. This calculation tells you exactly what you own versus what you owe. On the asset side, you've got things like cash, investments, property, vehicles, and valuable possessions. And the liabilities side covers debts like student loans, credit cards, mortgages, auto loans, you name it. Just subtract the liabilities from the assets and boom, that's your current net worth. It's a simple snapshot, but an important one to gauge your overall financial standing and net wealth. Next, we've got the famous 4% rule. This is a guideline for how much you can theoretically withdraw from your retirement savings each year without running out of money too soon in retirement. The idea is that if you have a nice, balanced portfolio of stocks and bonds, withdrawing 4% annually should make your money last 30 years or more in retirement. So if you need $50,000 per year in retirement, you'd want a $1.25 million portfolio to pull from using this 4% rule. Of course, this is just a rough estimate. I always say take rules of thumb with a grain of salt since everyone's situation is different. Your specific portfolio mix, time horizon, risk tolerance, and spending needs can cause the sustainable withdrawal rate to vary quite a bit from this 4% benchmark figure. Formula number 3 is all about cash flow. This one subtracts your expenses from your income to show if you're running a surplus or deficit month to month and year to year. Knowing this cash flow figure is crucial for budgeting, saving appropriately, and making sure you're trending in the right direction financially. A consistent positive cash flow is what allows you to put money away for future goals like retirement, a home purchase, starting a business, or building an investment portfolio. Watching your cash flow on a regular basis allows you to identify areas to cut expenses if needed and gives you an honest assessment of whether you're overspending relative to income. Many people are shocked and they actually track their cash flow to find they have a negative number each month despite making a decent income. This formula exposes that reality. Those first 3 really set the foundation for understanding your current financial standing. Now we're getting into some formulas that gauge risk and sustainability when it comes to your finances. Things are about to get a bit more complex, so buckle up. First up is your financial runway, how many months you could go without earned income while still covering expenses using just your liquid cash reserves. This shows your financial resiliency if you lose your job, suffer an injury, or have another income disruption. The formula is simple. Financial runway equals liquid assets/monthly expenses. So if you have $30,000 in cash savings and your monthly expenses are $3,000, your financial runway would be 10 months, $30,000/$3,000 equals 10. Having a long runway gives you breathing room, while a short runway means you could be in trouble fast if things go wrong. Next, there's leverage ratios, which compare your total debt load to your income. Having a high leverage ratio means your debt is a huge portion of your income, which can be very risky if your situation changes. These help sniff out if you're getting overextended on debt and give you a warning sign to course correct if needed. A common leverage ratio is the debt-to-income ratio, calculated as debt-to-income ratio equals total monthly debt payments / gross monthly income. So if you have total monthly debt payments of $2,000 from mortgages, loans, etc., and your monthly gross income is $6,000, your debt-to-income ratio would be 0.33 or 33%. Most lenders look for a debt-to-income ratio below 36%, with a lower ratio being more desirable. The higher the ratio, the more leveraged you are and the bigger percentage of your income is going towards debt payments each month. This gives you less financial flexibility. On a similar note, you've got the loan minimum payment formula to calculate minimum loan payments based on the balance, interest rate, and term length of a loan. Seeing how a potential new loan payment could impact monthly cash flow is massive when deciding whether to take one on or not. You don't want to overleverage yourself with too much debt obligation relative to income. When it comes to investing, some of the most useful formulas revolve around calculating returns over different time periods. You can look at basic price returns over a month, year, or any span. Or more comprehensive total returns that include reinvested dividends and distributions. Then you can take it further by calculating compounded annual returns, which factor in how growth builds on itself over time. And inflation-adjusted real returns, which show growth after stripping out the impacts of rising prices. There's also the rule of 72, which allows you to quickly estimate how long it will take an investment to double at a given annual rate. Just divide 72 by the annual return, and that's the number of years for a doubling. No matter how you slice it, keeping tabs on returns versus your investment goals and benchmarks is crucial for reviewing performance and deciding if your asset allocation needs adjustment. The last couple formulas I want to hit on are more about adding perspective than pure math. First, there's converting expenses or investment gains into hours of working life. Like, maybe that $1,000 smartphone costs the equivalent of 60 work hours based on your income. Or those $500,000 in investments you've built up are generating passive income equal to 2,000 work hours per year that you don't need to put in at a job. Thinking of money in those tangible work hour or life energy terms can really change your mindset on what things are actually worth. Finally, we've got the lifetime wealth ratio, which looks at your net worth as a multiple of your total career income so far. It measures how efficiently you've converted earnings into wealth over your working life. While higher incomes will tend to skew this ratio higher, it can still highlight people who have been incredible super savers and investment mavens throughout their careers despite more modest means. At the end of the day, these formulas are all tools to give you a deeper understanding of your financial picture, where you're at, where you're going, what levers you can pull to improve your situation. They won't instantly solve all your money problems or make financial planning easy. But developing at least a working knowledge of things like net worth, cash flow, risk rates, returns, and putting numbers into relatable contexts can pay huge dividends over time as you build wealth. So there you have it, folks, my top 10 must-know money formulas. Let me know which ones were new to you or which you'd add to the list. And if you liked this style of video breaking down useful financial concepts, definitely show your support by liking, commenting, subscribing, and sharing with any friends who could use the money insights. I'll be back again with another fresh money topic to keep leveling up your financial IQ. Until then, keep mastering those formulas, reviewing your numbers regularly, and taking calculated action steps to build towards your biggest money goals.